Are you ready to launch your dream franchise but feeling uncertain about how to finance it? You're not alone. Franchise financing can be a daunting task. But what if I told you there are multiple ways to secure the funding you need to start strong? From traditional bank loans to alternative financing options, today we'll cover everything you need to know about financing your franchise. Whether you're just starting your research or already weighing your options, this video will help you make the right decision when it comes to funding your franchise business. Let's start with the most common option, traditional bank loans. If you have a strong credit history and are looking for a straightforward financing solution, traditional loans could be the answer. Banks offer various loan products specifically designed for small businesses, including term loans that provide a lump sum of cash to be repaid over a fixed period. But there's one potential drawback. Banks often have strict lending requirements. You'll likely need a good credit score, a strong business plan, and potentially even collateral to secure the loan. Plus, approval can take some time. If that sounds too daunting, there's another widely used option, SBA loans. The Small Business Administration offers several loan programs for small businesses, including franchises. The benefit here is that the SBA guarantees a portion of the loan, making it easier for lenders to approve financing for businesses that may not meet traditional loan criteria. SBA loans often come with lower interest rates and longer repayment terms, which can be a big plus. However, similar to traditional loans, the application process can be time-consuming and requires extensive paperwork. Pros of traditional loans include established financing option, wide variety of loan products. Cons of traditional loans, stricter credit requirements, lengthy approval process. Pros of SBA loans, lower interest rates, easier approval for those with less than perfect credit. Cons of SBA loans, lengthy and paperwork-heavy process. So who should go for these options? Traditional loans and SBA loans are ideal for franchise owners with strong financial backgrounds and those who can navigate the extensive application processes. Next, let's dive into some alternative financing options that might suit your needs better if traditional loans seem out of reach. One popular alternative is franchise-specific financing. Some franchisors offer financing programs directly to franchisees. These programs are often designed to cover startup costs like franchise fees, equipment, and initial working capital. The big advantage here? The financing is tailored specifically to the franchise business model, making it easier to qualify for than a traditional loan. Another option is a business line of credit. Instead of receiving a lump sum up front, a line of credit works more like a credit card. You only borrow what you need, and you'll pay interest only on the funds you use. This can be a flexible option for managing cash flow, particularly during the early stages of your franchise. Equipment loans are another form of alternative financing. These loans are designed specifically for the purchase of equipment, which is often essential when starting a franchise. The equipment itself usually serves as collateral, making the loan easier to secure. Finally, there's the option of alternative lenders, who offer more flexible qualification requirements than banks. These lenders often have faster approval processes, but they may come with higher interest rates. Pros of alternative financing: faster approval process, more flexible qualification criteria. Cons of alternative financing: higher interest rates, especially with alternative lenders. Some may not cover all franchise costs. If you're a franchise owner who needs quick access to capital or can't meet traditional lending requirements, alternative financing options could be the perfect fit for you. With so many options available, how do you choose the right financing for your franchise? The answer largely depends on your financial situation and your long-term business goals. First, evaluate your credit score. Traditional and SBA loans will require good credit, so if you're on the lower end, you may want to consider alternative financing options. Next, think about how much down payment you're able to make. Many loans, including SBA loans, will require a down payment, usually around 10 to 20% of the loan amount. Be sure to factor this into your decision-making process. Also, consider your franchise's financial needs. For instance, if your franchise requires a lot of specialized equipment, an equipment loan might make the most sense. On the other hand, if you're unsure about how much funding you'll need upfront, a line of credit could give you more flexibility. Ultimately, it's important to shop around. Don't just settle for the first financing option you come across. Compare loan offers, interest rates, and terms before making your decision to ensure you're choosing the option that best supports your franchise's growth. In summary, whether you go with a traditional loan, SBA financing, or an alternative lender, finding the right financing is key to building a successful franchise. Each option comes with its own set of pros and cons, so be sure to choose the one that aligns with your business goals. If you found this video helpful, hit the like button, and don't forget to subscribe for more valuable business tips. And if you're ready to take the next step in franchise financing, check out the links in the description to get started on your journey today.